just want to thank all of y'all for being here. I'm going to open us with prayer and blessing, if you would. All right. Please join me in prayer. Dear Heavenly Father, thank you for this day that you have made. Let us rejoice and be glad in it. We give you praise and thanks for this time, this opportunity for us to be together in fellowship and in service. We ask that you be with us during this time. We pray for our church. We thank you for our church. We thank you for this season in the life of our church, and we ask that you continue to bless our church, all of our members, our community, those who've come before us. Help us build on what they've done and what you've blessed us with going forward. We thank you for this food. We ask that you bless it for us and us to your continued service. Amen. Okay. We started on time, Brandy. Thank you all again for being here. My name's Steve Sanders, and I think this will be a great opportunity for us here today. We started talking about this panel a few weeks back in connection with the Capitol campaign, and we thought this would just be a great opportunity to learn from some of our own members who we think can help just share some valuable information for all of you. So I'm going to introduce our panel up here and kind of go over what we're going to talk about, and then I'm just going to turn it over to each of us to talk about a few things as far as charitable giving and some tax information and related benefits and recommendations and things like that. So I'm Steve Sanders. I'm a partner at the Fulcher Hagler firm, 14 years, primarily estate planning, tax planning, estate trust administration. And this is Tommy Jones from Jones Davis, CPA certified financial planner for 35 plus years. So he's going to cover a lot of sort of general charitable giving rules and some changes that are coming up that you probably will want to know about that may influence what you do in the next couple of years. Marshall Brown, retired, longtime vice president at Stiefel, financial advisor, 25 plus years. Anything else?
That's good.
Okay. Anything else? And then Shell Berry is here to pitch in and help as well. President, CEO of the Community Foundation for 10 plus years now. So we're going to try to just hit the high points, and we're happy to take questions sort of throughout. We want this to be kind of a discussion. If you have questions, we'll try to repeat the questions in the microphone so we can capture it on the video. And so with that, I will turn it over to Tommy, and he's going to cover. There are some agendas that I put on the back table back there just to give you kind of the outline of what we're going to cover. And there are some handouts on the table that I will speak to as we hit those topics. So, Tommy, thank you.
Yeah. Good. Thank you, Steve. Can you hear me okay? I'm going to talk a lot about the One Beautiful Bill, and you could put a little smiley face with tears coming out of the eyes when I say that. It did increase the budget deficit like $5 trillion, but whatever. One of the biggest and most important and helpful tax law changes in my career is not the One Big Beautiful Bill. Okay. All right, can you hear me? Okay, I got you. The most important and most helpful tax law change in my career is not the One Big Beautiful Bill, but it's the tax law that was changed back in December of 2024. Congress passed and the President signed December 12, 2024, the Disaster Relief Act. Well, why am I talking about this? This is charitable. You know, if you haven't claimed hurricane expenses, that's what that's all about. there's money left out there in the parking lot. It's just waiting for you to go pick it up. And I want you to give that money to the church. So I'm still picking up clients that come in this week, 2 clients. Well, the insurance paid for everything, and, well, what about those? I know where you live. You live in Westlake, you live on Walton Way. What about those trees in your yard? The insurance didn't pay for that. Yeah, I had those. So before you know it, you've got $15,000, $20,000 of tax-deductible expenses. What that tax law did was it did away with the 10% of adjusted gross income limitation. So once you clear $500, it's totally deductible, whether or not you take the standard deduction or itemize. So just wanted to throw that out there. Then what I'm talking about now is it's going to be a lot of acronyms, and I'll go through those. I hate it when somebody gets up and I'm on a director of a bank, and they kept talking about the BSA, and I said, well, what is the BSA? That's Boy Scouts of America to me, but it's the Bank Secrecy Act. Anyway, the first page, Obama's secret gift. I didn't say Obama, as an OBA, secret gift, bigger tax breaks for QCDs. Well, what's a QCD? That's qualified charitable distribution from your IRA. And you've got to be 70 and a half years old. There are a lot of people in here I know that not 70 and a half, but maybe it's your parents, we're talking about. That they have to do these required minimum distributions, and what better way than to do that required minimum distribution is to do a qualified charitable distribution to the church. So the qualified charitable distribution can be a very tax-smart way to satisfy your charitable inclinations. Okay, here's the basics of the QCD. It has to be a traditional IRA. So there's a SEP IRA, a simple IRA. You can't do it from those if it's an active account, meaning you made contributions in that year, so it has to be a traditional IRA. You can transfer or roll over a SEP or simple into a traditional IRA if you aren't using it anymore. So that's overlooked a good bit. You don't claim any itemized deductions for the QCD. So you gave the church, say, $20,000 during this capital campaign. You don't claim that as a charitable donation. Well, that's okay. It's better than okay, because that $20,000 is not going into your income. And you've got all of these tax law rules. You've got the Medicare rules, that go off your adjusted gross income. It's called MAGI. That's modified adjusted gross income. No one's bringing you the gold and frankincense and myrrh, but modified adjusted gross income is basically your adjusted gross income plus your tax-exempt interest. So on page 2 there, to be a QCD, an IRA distribution to your church or charity must meet the following. You're 70 and a half. It must be transferred by your IRA trustee directly to an IRS-approved charity. The funds cannot pass through your hands or any person hands in any fashion. For example, cannot be deposited in your account other than the one belonging to the charity. You've got to be sure that the church receives the funds and cashes it before December 31st. There was a tax case this year where a $25,000 contribution was made from the stockbroker firm to the, I don't know if it was a church or wherever it was, but for some reason it got lost and it never got there. And with the mail situation we've got, you've got to be sure that money is actually delivered and deposited, by the church. If not, there's a 25% penalty for not taking that required minimum distribution from your IRA. I've already talked about you cannot do a QCD from an inactive. Yes, you can do a QCD from an inactive SEP or simple, but that means you had no employer contributions during the year. And you can do the limit is $108,000 each for each spouse. So you could do $216,000 QCD. Once again, you got to be 70 and a half. And someone says, well, I thought the RMD was 73, which it is currently 73, but you can actually, if you're 70 and a half, you can do one of these QCDs. It has to be direct transfer to a qualified public charity. It cannot be to a donor advised fund or private foundation. That's a common mistake. And also, as I said, double check to be sure the charity is approved for QCD, and of course, our church does qualify. Does a QCD make sense for me? It provides several tax benefits. It's suitable for donors who are required to take RMDs and don't need the funds. Can do a QCD from an inherited IRA, and the answer is yes, but only if you are at least age 70 and a half. And you would also like to reduce the balance in your IRA to lower future required minimum distributions. You also would like to make a larger charitable gift than you could make by simply donating cash and appreciated securities. The value of deducting charitable gifts ranges from 20 to 60% of adjusted gross income. 20% AGI, adjusted gross income, is certain private foundations. 30% AGI is gifts of appreciated stock, securities held for more than 1 year, and 60% of adjusted gross income is cash to public charities. So anything over and above 60% of your adjusted gross income, any excess can be carried over for 5 years. There are a lot of new rules by keeping your income lower. There's something that some of the upper income people would be, back in 2017, the Tax Cuts and Jobs Act, it was a phase out of the SALT deduction. Well, here's another acronym. That's the state and local tax. You can only deduct $10,000 of state and local taxes. That's state of Georgia property taxes. But this is one big change in this new law that was just passed. For 2025 to 2029, the new law increases the SALT deduction to $40,000 or $20,000 for married filing separately. That's a big increase from the $10,000 that it was. And that's phased out between $500,000 and totally phased out at $600,000 of adjusted gross income. One of the last things I'll talk about is QCDs, the qualified charitable distribution, doesn't increase your adjusted gross income or your MAGI. That's the modified adjusted gross income. And so your odds of benefiting from these breaks are higher. You avoid the Medicare insurance surcharges. That's another acronym here. I call it IRMAA, I-R-M-A-A. Well, once your income goes up, IRMAA goes up, and which is income-related monthly adjustment. So your Medicare charges can really go up if your income is higher. So the qualified charitable distribution can hold your income down. It takes it out of adjusted gross income. Also, you can avoid the 3.8% net investment income tax on dividends, interest income, and capital gains. I don't know what else I need to talk about here. The standard deduction has gone up tremendously. This will be the last thing I'll talk about. Consider bunching your charitable contributions. Marcia's going to talk about a donor advised fund, but if you're giving, whatever, $5,000, and you're going to make a pledge to give $20,000, give it all in 1 year. So it'll get you over the standard deduction limit, and you'll get a tax benefit from that. I've already talked about the tax court case, and this is the last item, that the QCD check never cleared the bank of the charity. So that was not good. So they had to pay it was a $20,000 check that never cleared for the RMD. So it's a 25% penalty on that. So it's a $5,000 penalty. So Steve, I'll turn it back over to you.
Yeah, there's just a couple things that I might just sort of summarize or add on that, because I do want it to be very clear. If you are 70 and a half or older, and if you are required to take a required minimum distribution from your IRA, that's based on your life expectancy, you are required to take that out every year. It is taxable ordinary income to you when it comes out to you, because you probably got a deduction when it went in. And so instead of taking the money out, counting it in your taxable income, and then turning around and making a charitable contribution to the church, which I think a lot of people do it that way, it's a greater tax benefit to just do the qualified charitable distribution directly from the IRA to the charity, to the church. If you do that, it does not count. It never counts as your taxable income. It is excluded from your taxable income. So that is a better way to do it than taking it out and then turning around and making your annual gifts. So I just want that to be clear. Yes, and obviously it does satisfy your required minimum distribution. So you're checking that box, but it's never counted in your income. And I'm sorry, what was the question again?
Well, if it was more than what you're required to take out, if you wanted to donate more than what you have to take out every year, you want to take more out of your IRA.
Yes, you can always take more. And up to $108,000 a year per person. Okay. Yes.
So I know you're talking about diverting your RMD into the QCD after age 70 and a half. Can you, younger than 70 and a half, do a QCD from your IRA to a charity and divert the income from yourself to the charity?
No, you have to be.
You have to be 70 and a half.
You have to be 70 and a half.
Okay, thank you.
Yeah, age 59 is just the date that you can make a distribution from an IRA and not pay the 10% penalty, but it's still going to be included in your income.
Okay, any other questions on that? Okay. Marshall's going to talk about donor advised funds.
Yeah, I want to talk a minute about donor advised funds, or DAF. DAF is an investment account for the sole purpose of supporting charitable organizations. The way it works, you would select a sponsoring organization such as a bank or a brokerage firm. A lot of people in the CSRA go through the community foundation to do that. And you would deposit securities, cash, as Tommy's mentioned, cash, securities, bonds, assets into this account. And when you do that, you get an immediate tax benefit from that. That's a tax deductible gift. And then you have years to spread that out and give it to the charities of your choice. It's irrevocable, so you lose control of that, but you choose where and when your gifts are made, and it's a efficient way, very efficient way to give. I put a handout on everybody's table that just kind of goes over that. You can, as Tommy mentioned, you can contribute 60% of your AGI, adjusted gross income, in cash, and 30% in adjusted gross income in stocks. A good example for this, let's say you had a nice big bonus one year, or you sold a piece of property, or you had a big capital gain. You might take advantage of that by doing a donor advised fund. You can do that, and as Tommy mentioned, you can not do a standard deduction, but itemize your deductions. You do that for 2 or 3 or 4 years, and you've depleted your charitable account. You've given a 3-year pledge to Reid Memorial Capital Campaign, and you're given those 3 years. You can do it again. You're not limited to 1 year, or 3 years, or 5 years. So you can do it frequently. Most people do it, I think, every 4 or 5 years. It's an efficient way to give. It's simple. You have good record keeping from your sponsoring organization. You can usually do all that online with whoever you're dealing with, and it's just it's the fastest growing vehicle for charitable giving in the United States today, is the donor advised fund. It allows long-term charitable planning and gives you a lot of options. You can appoint family members or other loved ones to fill your shoes when you're no longer able to do that, or when you're gone. So it's a very effective way to leave a lasting legacy of philanthropy.
Is this account managed, like it earns money while
Yes, it is. It is with an investment person, and it is managed. And I didn't mention, but the real benefit of it is as it grows, that's tax free. The earnings are tax free as it inside the account.
it stays in the account,
Right.
and the earnings are.
They grow tax free.
Can you repeat what she's saying so that it's on the video, so that whoever listens later?
Thank you, Denise. You mentioned that. So Judy's question was,
Do you manage, does someone manage?
is someone managing the investments? And the answer is yes to that question.
And I mean, Shell's
Yes.
kind of an expert on this
Not
too.
kind
So
of, she is expert on it.
and
She is.
So there are a lot of donor advised fund options, but I would strongly recommend the community foundation if that's something you want to consider. And Shell, do you want to jump in?
Yeah. So, I mean, Marshall has really talked about the, what's that? You want me to use
There was
that?
a mic.
Marshall has really talked about oh, it's another mic. There we go. Those can be for questions. The benefits of a donor advised fund. So they are, like has already been said, they can be, sometimes your financial advisor may have a donor advised fund product, and you can keep the dollars with your fund manager there, or you can put the funds at a place like the community foundation. The tax benefits and usually the costs are very comparable. Community foundations like ours across the United States have local expertise and we jokingly say that we answer the phone. So if you'd like to actually talk to a human about your donor advised fund. But they're a great benefit in this kind of scenario because you can plan. While donor advised funds cannot be legally bound by a pledge. So if you have a donor advised fund, no matter where you have it, and you make a pledge to the church, and you intend to pay that pledge with the proceeds of your donor advised fund, you can intend to do that, but you cannot tell the church, my donor advised fund has made this pledge. So that you cannot bind the holder of the donor advised fund to pay it on your behalf. So in other words, the church can't leverage that pledge, and the church can't go after the donor advised fund holder for payment of that pledge if you decide not to pay your pledge. Does that make sense? So it goes back to the fact that donor advised funds, once you give to a donor advised fund holder, which is always a public charity, you take it the full tax deduction that you would take to any other public charity. So you've already received the benefit of making a charitable gift. So if you exert undue control over that gift after it's been given, like relieving a debt you have, a pledge can be seen as a debt, the IRS considers that a no-no. But if Shell Berry made a pledge to the church, I'm gonna make it big. Let's say I made a $100,000 pledge to the church. And for tax planning purposes, it made a lot of sense for me to go ahead and put $100,000 aside in a DAF, and I'm gonna give it in $20,000 increments over the next 4 years, $25,000 increments to the church. I can do that, but I cannot tell the community foundation, you have to pay the church $25,000 each of the next 4 years. You have to log into your donor advised fund each year and request a grant that donor advised fund pay your $25,000 pledge, which it can do, but it's a subtle nuance. Is that clear? Yes, ma'am. Hold on.
Why is that better than just making why is that better than just making flat out donation and deducting it on your taxes yourself?
You can. It's not better. So the advantage of doing it over time like that is, one, possibly the invested growth, so the fund can grow over time. It could be that you're combining different assets into a donor advised fund. So let's say you have cash assets as well as a charitable required minimum distribution. You can put all of that in a donor advised fund and take one charitable deduction, and it's just administratively easier. There's really not you can make a gift straight to the church. Would y'all answer that? Yeah, you can always make a gift straight to the church. Absolutely. Yes. I'm gonna get my exercise today.
Can you give assets like real estate as well as cash or stocks and things?
Yes. So the Community Foundation, I cannot speak for other holders of donor advised funds, but the Community Foundation can take a wide variety of assets. We've taken private interest in businesses before they've sold. We've taken beneficiary interest in insurance policies. There's a variety of assets that we can take, and we work with you to liquidate those to meet your grant-making needs over the future. Back. Well, I think it's for the recording is why we want it.
Okay. All right. By the way, thank you for all the work you do, and thank you all for this wonderful presentation. Steve, it's my understanding that charitable pledges and gifts are now enforceable. You can collect them. They're not uncollectible as they used to be under the law. Now they are collectible. Is that correct? A pledge can be collected if it's not paid legally.
I don't know.
Isn't that true?
I don't know the answer to that.
Okay.
Sorry.
I'm thinking.
I don't know if there was a change or something you're referring to. I'm not familiar with
There
that.
was at some time. Shell, are you familiar with what I'm talking about?
I'm familiar enough to not be familiar, but my understanding of that, and you're the lawyer, as is Steve.
I was. I'm retired.
My understanding of that is that it depends on the document you signed when you made the pledge.
All right.
So if you sign a binding contract with an entity, so a lot of times you may have given a large gift to a university. Oftentimes they will have you sign a gift agreement that commits you to that, and that, I think, has gotten more traction in the courts to be upheld.
All right. Thank you. And the reason I asked that was because when we've served on the session before, and sometimes people have suffered financial setbacks or something with a significant pledge, we've had to decide whether or not to go after it. Used to be you could not. It was not an illegally enforceable gift. I believe that has changed. I believe the law changed, and I'm retired, so I don't know the answer to that. That's why I'm asking. But I think it would have more significance now when we're talking about raising several millions of dollars than it did when we were talking about going after 50,000. So I think maybe the idea is to make sure you choose a good DAF if you're going to do this, because as I understand what you're saying is you can tell the church that you've given the money to the DAF and you hope the DAF does what you've asked them to do. Is that right? Can you tell the church?
You have set aside money in a DAF,
Yes.
but you cannot tell the church that the DAF now has that obligation.
Okay. All right. So are you obligated to the church if you?
So once again, I would take that down to whether or not you made a contractual obligation to the church.
Yeah.
As far as I know, we are not requiring that anyone who makes a pledge to this capital campaign is making a contractual obligation to make that
I
pledge.
think the pledge cards are a contract.
Okay?
Do what?
She just said.
Am I wrong, Brandy? Oh. All right.
So
Okay.
you're over my head now.
Well, mine too. That's why
Right,
I'm glad
right,
we
right.
got the experts in.
However, I might be speaking for Brandy, but in all of my experience with fundraising, you expect a certain percentage that will not be collectible.
Okay.
And I would expect, given our current leadership in the capital campaign committee, that we would be wise to consider a certain percentage that won't be collectible, and that we would not be in a position to go and chase someone down for the payment of that pledge who's no longer capable of making that pledge.
Whether we take someone down or they're taking us down, I guess is a fault. But so I guess the idea here is just to be very careful of the DAF that you choose and have a good trust in your DAF that they will do. And when you're giving it through a DAF and hope that the DAF gives it to the church, you just kind of wink at the church and say,
Still an active,
no.
No,
you still have to actively go into the DAF account and tell it to make the distribution.
correct.
I'm talking about the relationship. I'm talking about the relationship between the church and the donor.
Church doesn't have a relationship with the DAF.
Okay.
That's correct.
Oh.
The church would not have a relationship with that.
But I'm talking about yes.
Okay, let's talk about that. So what if the person is deceased and there is money in the DAF?
The agreements, I will say, that the community foundation makes it very easy to set up. And in my experience, obviously the donor's intent is always very important. And that's part of your agreements that are set up for each fund. There also, by the way, are a lot of different funds that are already doing probably a lot of things that we all want to support. But it's not a very sort of extensive process, but that is part of the record agreement that goes with the fund.
So, I mean, almost all donor advised fund holders of donor advised funds are going to ask you about a successor advisor. So you will have someone listed on your donor advised fund who has the authority to make gifts on your behalf after you are gone. And certainly you can plan charitable assets through your estate and list the donor advised fund as one of your charitable assets to be managed by your executor or your successor advisors. So someone on your behalf could continue to pay out of your donor advised fund to meet your charitable wishes.
Yeah, so a lot of times if you do that, which we do sometimes as part, and we do have sort of an estate planning part of this at the end, but is to basically state those wishes in the will or the trust, and typically, or a lot of times, the children or others that the testator knows would be part of that process with the fund to sort of have the legacy continue with the actual dollars that go with the donor advised fund over whatever period of time it continues into the future. So you can actually designate that as part of the initial agreement.
You
Now,
can.
You can't bind what ultimately legally happens after that because it's a completed gift once it's made. But that is a part of what the Community Foundation does, and I assume other.
Yes. So Steve mentioned we have a lot of other funds. So currently, there is a fund set up to benefit Reid Memorial Presbyterian Church. And it is receiving stock gifts right now, appreciated stock gifts for this campaign. And if that fund could be a recipient of your donor advised fund proceeds, or you could go ahead and name anything left in my donor advised fund at my death goes to Reid Memorial Presbyterian Church. So you can, there are a variety of ways that you can make sure that that happens.
One other point, you can't benefit from your donor advised fund. For instance, if your favorite charity was having a golf tournament and it was $1,000 a team, you can't use that as a benefit. You can't get any benefits yourself. Yes, Paul.
So if you had an asset, if you had an asset, it might be real estate, it might be stock, but anyway, you want to sell it, and let's say it was worth $50,000, and you're currently pledging $10,000 a year. So can you donate that and then have them distribute it, or would they donate it to the church and say, here's $50,000, but this is for my next 5-year pledge? How would you do that?
I'm not sure I know, Tommy.
So any gift that you give, so the benefit of doing something like that to the community foundation is we have the expertise to liquidate whatever that asset is, and you get the appreciated value of that asset on your tax. So let's say you had basis of $10 in a bunch of stock, and that stock is worth $50, and you donate that share to the community foundation, you get that $50 deduction. You do not pay the capital gains tax on the 10 to 50, and then the donor advised fund can then make charitable gifts on your behalf. But if for some reason, after hearing this presentation, let's say you've made a $40,000 pledge or $30,000 pledge over the next 3 years to the church, and you have a $50,000 asset that you want to donate this year because it makes sense for tax purposes, you could do that. You could decide whether you want to go ahead and send 30 to the church right now or send 10 this year, next year, and the following year, and then the other $20,000 you can give to any charity of your choice.
Thanks, Shel.
I'll keep the man awake.
Yes, sir.
Yeah.
Thank you.
The thing that Ben said concerns me, the fact that a pledge card is a contract.
Yes.
And that means that the churches then can go after that amount. So that, to me, would make me want to say, well, my pledge is going to be in voice,
I would,
Okay,
which I don't
wait.
mind.
Whoa,
mean,
Jerry,
If I don't have the money, next year,
calm down.
Well, if I
Everybody's
don't-
okay. That I thought that was a really interesting point, and all of this is way over my skill set financially. But let me just say, what's not over my skill set is to say you can trust the church, at least under what we said earlier, at least at this current moment with your current leadership. We know things happen from time to time. People have family crises, people divorce, people die, and pledges aren't met. And I cannot imagine a day in the life of Reid Memorial where someone would go after that and try to say it was a contractual relationship. At least that's my opinion.
So where you would get in that situation is if, which is not going to happen here, the church has taken on binding debt. And we cannot pay that debt based on people not paying their pledges. That is not the intention of the session. We will know after all of you are extraordinarily generous on Kirking Day. We will know exactly what we're dealing with, and the campaign commitments relative to construction are going to be bound by what we learn at the end of this capital campaign. And right now we know that it is looking very likely that we will not have to do anything other than potentially a short-term construction loan somewhere in this process. But we will not be spending dollars we don't already have committed. And once again, the percentage we can deduct, let's say we raise $12 million. Let's say we raise $14 million.
Let's say it. Let's say 14.
We as a session could decide we expect 10% of that not to be collectible in the later years. Pledges that are pledged over a period of time, we're going to discount that amount of money, and therefore we're not going to spend. We're going to consider that a contingency. So there are some wise things we can do now that would prevent us from ever being in a situation where we would even contemplate going after someone because they signed a pledge card. Pledge cards are incredibly important for us to be able to make the kind of good decision-making I just mentioned. So if you don't sign a pledge card, we can't make those kinds of smart business decisions.
So let me say a couple things about that. So some of you in this room have already made a pledge. And so if you were here the Sunday that we kicked off the campaign, you heard us Scott announced that there was a $12 million goal, and at that point, we had 8.5 of that pledged. That number has continued to grow because I've continued to have one-on-one conversations with some of you about what your pledge will be. So what I want to say is I would love to continue to have those conversations, and then you could have a conversation with any of these experts, and they could advise you on the details of those. I do want to say, which I hope will lead to the kind of tee Steve up for the next part of what he might say. I just this morning was talking to a friend, and she said, "Oh, it must be so awkward to have to talk to people about money." And I said, that is such an interesting perspective. It has been and continues to be such an honor. We know that every good gift is from God, and this is one of the many gifts that has been entrusted to our care. And it is an honor to get to talk with people about being part of something bigger than them, something God is doing. And I'm really happy to have those conversations. I can tell you that those conversations have looked different with different generations. I had someone not probably in this room, but someday I had someone in my office not long ago who said, "I have kids in college right now. So I want to make a pledge for this, and I can tell you that in 2 years, everybody's out of college, so I want to pay my entire pledge in year 3. Can I do that?" And I said, "Sure, for your family, that makes perfect sense." Someone else the same day sent a check with a Post-it on it that said, "I'm concerned about the market. Take it while I have it." That's real.
Fair.
Another person said to me, it was a very serious conversation. She said, "I just don't know how long I'm going to live. I don't know how much money I need." And I said, "Then let's do this. Why don't you make a pledge that you feel confident in and comfortable with, and then will you please go see your attorney and talk to them about remembering the church in your will." This church has not done a great job of having a legacy giving program, and I didn't want to come at you with a capital campaign and legacy giving all at the same time, but we're going to do better at that in the future because we have a responsibility to steward the resources entrusted to our care even after our death. So that's, if there are people with that question, and now Steve is an estate planning attorney, so he will give a commercial on how to do good estate planning.
I do just want to say a couple of other things about that, though, Ben, and I appreciate the question. I'm going to find out the answer, but I don't know that I've never thought that that was the case with a pledge to the church, and I don't know that we've ever taken that approach to that. And I also just think I say this a lot, there's the legal technical answer for a lot of things, and then there's the practical real world answer for a lot of things. If we ever took that approach, I have to think it would be a substantial deterrent to future giving, right? So, and so there's, just because you maybe legally could do it, I don't know that that would be something we would do. No guarantees, of course, legally speaking, but that's just my.
Thank you, and I guess I was referring to something that maybe you're getting ready to get into now, but in the old days when I used to write wills before I turned them over to people who knew what they were doing like you later on, we would always include a clause that would say that any charitable gifts were intended to be collected, and I want them to be paid because we knew they were not legally enforceable then. I believe the law changed,
Okay,
and now they are.
Yeah.
But so I think that was what I was referring to, and I
Okay.
guess also I'm not necessarily referring to people not wanting to pay their pledges, Brandy, or a church going after anybody. But when people die, as Steve might refer to, the heirs and the beneficiaries may have other ideas about where they want the money to go. So that's one reason we want to be legally enforceable. Okay? Thank you.
Yeah, and we do still have provision in most of our wills to that same effect, that, pledge charitable gifts to be honored out of the estate. And so I was just going to talk about that part briefly. Obviously, wills is a big part of what I do, and trusts. A lot of people have trusts that are more like will substitutes. So testamentary giving to the church. And there's obviously, I always try to include that as a discussion for folks to consider. Not everyone considers it, but I do think it is something that I ask people to think about. And there obviously are tax benefits. Most people now, with the estate tax exemptions, you're not going to get a charitable tax from the estate tax because it doesn't apply to 99 point something % of people. The exemption is $15 million per person, so starting next year, at least for the foreseeable future. But like income taxes is a much more bigger part of what all we're doing. And so the main thing I wanted to say about that is if you do have any inclination to include charitable giving as part of your estate plan, there are better ways to do it. Most people think they want to, your will or your trust would be the place where you would just leave, I want to leave X dollars or X % to my church. But if you have any kind of retirement account, like a IRA or a 401k that's taxable, when it comes out, it is better most of the time to use that account, that asset, to make your charitable gift. And I encourage people to think about that, because if you make a 10% gift in your will, which comes out of your probate estate property, and then you leave your IRA to your children, they're going to have to pay income tax when that IRA money comes out, and they have to pay it over a quicker amount of time. But if you leave the amount you want to leave to the church in the IRA as a charitable gift on your beneficiary designation in your IRA, that goes directly to the church outside of probate, and there's no income tax that ever gets paid on that. So there is a potentially significant tax benefit overall to all of the beneficiaries by doing it that way. It's also more flexible. So your IRA, for example, has its own beneficiary designation as part of the IRA contract. So you go to Marshall or whomever your advisor is, or online, and you can update your beneficiary form at any time, rather than having to go and change your will or your trust, which is a much more legalistic process. So I just like to encourage that as a big consideration to think about. So you may have $1 million IRA and you want to leave $100,000 to the church. You can designate that on the IRA itself, and then of course the rest of it would go to your kids or whomever. And that goes directly. You don't have to wait on probate. You don't have to go through the administration, and there's a tax benefit to it. So that's an example of the kind of thing that I usually talk about. You can do the same thing with life insurance. You can designate a charity on a life insurance policy for a portion of it if you want to satisfy or make a charitable gift. That's another easy thing you can do that is outside of probate or the administration and goes directly to you don't get the same tax benefits with that, but it's still an easy way to make a gift to a charity outside of all of those other rules. And then you don't have to put that in your will or your trust. I think that's all I'm going to cover on that. I did. Does anybody have any questions about? Yes.
Hold on.
I'm interested in about the legacy fund, because if you do leave from your retirement account a large amount to a charity, does that amount go into an operation budget, or could it go into a legacy that could last for years?
So you get to choose. What every charity I've ever dealt with will say is we prefer unrestricted gifts. But I think you can designate, we may have our own policy on that, but through the church, but you can specify, and I've seen that a fair amount, you can specify that your gift be used for whatever purpose. If you do that, I would recommend checking with the church to see what the options are, just to make sure that the gift is actually going to work the way you want it to. But I know I've seen one that wanted to be used for like the music ministry, for example, and you would need to put that in there. But there's probably a right way to do it with the language in the church or with charity or whomever could.
Yes, so two things. Building off what Steve just said, the church does have a gift acceptance policy. So that's just been written with this campaign. So, and I'm not sure the session has made that so the session has approved that as the gift acceptance policy for the church. So some restrictions you may be thinking of may not fit within that gift acceptance policy, but we can certainly talk about it. The legacy fund is the endowment that we have contemplated alongside this capital campaign. The goal is to have $1 million that is preserved in perpetuity, and the earnings off of that $1 million, the growth and earnings off that $1 million would be available for improvements. So like we wouldn't be in a position 30 years hence that a air conditioning unit went down and we didn't have the capital to make those improvements. So trying to do a better job of taking care of the improvements that we're about to make, so that someone else is not tasked with trying to figure out how to do that in the future. So that campaign is to raise $1 million for that. There's already a foundation. Marshall, do you want to say anything about the foundation? You don't have to. Okay. This church has a history of managing and running restricted corpus for the benefit of the church. Hold on just a second, Harry.
A related question, and I don't think you mentioned it, but the probate, what we've done on most all of our accounts is pay on death to our beneficiaries. Is that of some help in this situation as well?
I think you can do that with a charity, can't you? Yeah, I think you can do that, and we do. I try to be a little bit more careful with those because, but that is a way to leave accounts. POD, payable on death, is typically for bank accounts. You designate a beneficiary on the account, it goes straight to the beneficiary at your death, does not go through probate. TOD, transfer on death, is for
Same thing, isn't it?
secure stock, mainly for like investment accounts. Same exact idea, and I'm pretty sure you can designate charities on those as well. POD, for bank accounts, mostly that's not. I typically wouldn't recommend that unless it's a very large account. But TODs, you may know that. Have you ever seen that?
I have
TOD?
not.
Yeah, but I think you can do that.
But that's just a simple way to set up. That's what we've done on everything.
Yeah.
All accounts are pay on death. Of course, it's to our children, but there may be other things to do that would be simpler than some of these others. And we've already spent all the money of what we had to take out of the IRA. We've already donated all that.
Okay, that's what I was going to say, is if you did have an
We've done it
IRA
for this
sitting out
year.
there, it would be more beneficial to use that from an income tax
I'll
standpoint.
mention that this is one of the things that how people have used donor advised funds. So they set up a donor advised fund, and then the beneficiary of charitable assets in any of those accounts can be the donor advised fund. And then you work with the donor advised fund holder to determine your charitable intent. And your charitable intent can change over time. You don't have to go back and change all of those documents. Whatever your testimony documents are, it's just a simple account, and then you can name successor advisors. You can talk to your children about what your wishes are. You can set up restrictions on that charitable account to go to a variety of charities. So that's one way you can have one place that can then give to a bunch of things that you care about. Harry.
I think this is back to Tommy. Tommy, did I hear you say there's some advantage to make a payment before 12/31 this year? Would you explain that again?
As far as a QCD,
Any particular advantage because it's 2025, 12/31?
yeah. Well, I was talking about bunching deductions, which, you maybe take at least 2 years and make it December 31st, be sure the church gets the check before December 31st so it can get on your, statement. If you do it online, I actually did that to a charity, and it was on December 31st, but they didn't put it on my statement. I still deducted it, so it's better to not wait till the last minute.
I'm not talking about the timing, but just is there any particular
yeah.
benefit to doing it this year versus
Oh, okay.
2026?
Well, the rates are the same. The TCJA rates, up to 37%, all of those were the same exact. Now, in 2026, there's a special, that if your income is a certain level, your charitable contribution gets reduced by 1%. So,
It also depends
Yeah.
on whether you itemize or not.
yes. So it is better to go ahead and do it in 2025, is what I'm telling my clients.
Okay.
Yeah, and I would add just a couple of things. So for the standard deduction, which currently you don't get the charitable deductions if you're under the standard deduction, which is, I think it's about 15 or 16 individually, 31, 32,000 for a married couple. So typically you would have to have more deductions than that to itemize and get a charitable deduction. So itemized deductions is where you would get the charitable, and that there is a change under the new law starting January 1. There's like a 0.5% floor that if you itemize, then you have to give more than 0.5% of your adjusted gross income to even get a charitable deduction. That is not currently the rule. That floor does not exist. So if you itemize, that is a fairly significant incentive to give this year. And all that's why this is all related. A donor advised fund, bunching deductions into 1 year, or just making a larger direct gift to the church before the end of this year would be better than next year. You have to give more than 0.5% of your AGI to get the deduction starting next year.
Yeah, I didn't want to get too far in the weeds, but I don't know what page, about the middle part of, I talk about the itemized deduction. The standard deduction in 2025 is, if you're over 65, is $31,500 plus $1,600 plus $1,600, both spouses being over. So the standard deduction is $34,700. That's really a typo right there. It should say married filing jointly. And then for single people, the standard is $15,750. If you're over 65, then it's $17,750 standard deduction for single. And there also is a senior deduction of $6,000, where they were talking about, you aren't going to pay tax on your Social Security. Well, you will pay tax on your Social Security, but there's a $6,000 deduction if you're under $250,000. It starts phasing out at $150,000 of adjusted gross income, and then phases out totally at $250,000.
Yeah, there are some caps that are pretty high. If you're in that range, you probably want to talk to somebody about the caps. But and the only other thing I would say is it's almost for standard deduction now this year you don't get charitable. If you're a standard deduction taxpayer, you don't get charitable deductions on your tax return. But starting next year, even if you take the standard deduction, you can they will let you deduct $1,000 per person or $2,000 per a couple. So for those who are standard deduction, which I think is like 85-90% of taxpayers, starting January 1, you will actually get a charitable deduction for $1,000 or $2,000 for a couple, which would be good for maybe some of the younger folks to know.
And of course, if you do itemize in 25 and 26, I mean, those main deductions, itemized deductions, are medical if you're over 7.5% of your adjusted gross income, plus taxes. You know, now that's been increased from 10,000 to up to 40,000 based on your income, and then charity is a part of that. So if you add up together and you come over 65, both of you 34,700, then you would itemize. You know.
So if you've got a lot of those things this year already, medical expenses, mortgage, interest,
Yeah.
And you want to make a large charitable gift, this is a really good time to do it.
Making to give, my accountant and my advisor said to give the money to the church for this campaign, that I should give it with appreciated stock, not with cash. What's the advantage of that?
Well, if you paid $1,000 for that Coca-Cola stock and it's now worth $100,000, and you've held it for obviously over a year, you would get to deduct the full $100,000.
And there's no
There-
capital
No
gain.
capital gain.
There's no capital gain.
Whereas if you sold it,
If
Yeah,
you
you're
sold
paying
it
a lot
for
of
$100,000 and then gave $100,000, you'd pay a lot of tax. So,
I see Denise.
I understand the QCD is gonna be increased next year, like 115, but was 108 this year.
that's
Yeah.
right.
So increase
cap.
in the QCD cap is 115 next year as opposed to 108 this year.
Right. Yeah, QCD is a no-brainer
yep.
if you're 70 and a half. I don't usually like it when people say it's a no-brainer, but, I mean, I'm not selling anything. That's a no-brainer.
Are there any other questions? I think we're okay.
Well, I just wanted to say that, as a former organizer director of senior adult ministry, we leaned very heavily on a legacy fund that was established by Ellen Visser. And that corpus, as I understand it, Marshall, is not touched.
That's correct.
So just all the fund that I helped to produce and knowledge that we all gained when I did that was a gift from Ellen Visser and something that she set up many, many years ago. And that same fund has provided your lunch today. So I'm sure the Capital Campaign has a fund for their expenses. This was not one of them. So I just think when we think about legacy funds, we're doing that right now from something that was done many years ago.
And
Thank you. Yeah, that's good.
Actually, Ms. Visser was not a wealthy woman. I mean, she was sort of she was an elegant, lovely lady, but she didn't have a lot of money. But she gave it to the church, and it is amazing. She'd be so thrilled to see how that money has been spent and what it has amounted to. Because it wasn't that big amount when she gave it.
We need to spend more of it.
More events.
and I want to thank Denise for doing all the food and setup here for today. Sorry, I didn't mean to go there. Any other questions? I think that'll wrap us up. So I appreciate all y'all coming for this, and we can answer any questions anytime.
Good. Thank you, Steve.